From Deloitte Tax, welcome to the Tax News and Views podcast. In this series, we talk to specialists from Deloitte about the latest business issues. I'm Carrie Falkenhayn, your host for Tax News and Views. And today we are kicking off a new series focused on the sustainability credits that were included in the Inflation Reduction Act. Joining me today are Karl Obradovich and Bill Fisher from Deloitte's Global Credits and Incentives practice. And Karl, I'll start with you. There were over 300 pages in the Inflation Reduction Act devoted to clean energy credits. So what's in it?
Thanks, Gary. Yeah, there certainly was a lot of information, and many of the sustainability related credits were modified from prior drafts of the Build Back Better Act. I think the easiest way to look at it is to try to simplify it and put it into four main buckets. Those buckets would be advanced manufacturing, transportation and fuels, hydrogen and carbon capture, and renewable energy. And all the main credits in the Inflation Reduction Act will fit into one of those four main buckets. Deloitte actually prepared a detailed tax alert that includes observations and insights to describe what is in the IRA related to each of those buckets.
And so we've got a core four. What categories are most applicable to the companies you're speaking with?
It really depends on the company's sector, their fact pattern, and their ESG objectives and investment strategy. For example, companies that are doing a lot of manufacturing are going to be eligible for, or could potentially be eligible for, the Section 48C credit, which is a competitive-based application administered through the Department of Energy. It was actually around in 2010 and 2013. So many companies applied for it back then. I think there's going to be a lot more companies that apply for it this go around. There's also an advanced manufacturing production credit, 45X, that has the ability to potentially generate large credits. The other bucket of transportation and fuel, companies that are investing in electric vehicles or alternative refueling property or charging stations, those companies are going to be interested in those particular credits. And then carbon capture, or Section 45Q carbon capture sequestration, that's been around for a while. However, the IRA significantly enhanced the credit and reduced the thresholds that a company must meet in order to qualify for the credit. And then the hydrogen credit is a new credit. And then some of the renewable energy credits have also been around, but they've also been enhanced. So if you look at Section 45 production tax credit, as well as Section 48 investment tax credit.
So it sounds like there are a lot of new credits, as well as enhancements to existing credits. That's got to be overwhelming, and 300 pages to figure out. So where would you recommend companies start their analysis to see if there's any credits that are applicable to them?
Yeah, you're right, Carrie. There's a lot to evaluate. I think it's important to approach these credits and a company's investments broadly. I like to start with planning questions. What is the company investing in? Are they investing in anything related to green manufacturing or anything related to electric vehicles or charging stations? Does the company have investment strategies or sustainability strategies to reduce their carbon footprint or carbon emissions? The answers to those questions are going to lead you to the credits to try to focus on and see if your investments are meeting the credit criteria, the credits that fall within those four buckets that I mentioned earlier. It's also good to take a sector lens. There are certain sectors that some of these credits are going to be more applicable to than others. However, there are other, even for every industry, there's a little bit of something in the IRA for them because of the direct pay and transferability features that the IRA included.
Well, that's interesting, direct pay and transferability. Maybe, Bill, you can talk about how companies can monetize these credits.
Sure thing. Thanks, Carrie. So first, I think it's important to provide some general context. We tend to incentivize economic development in the U.S. through the tax code, and the IRA is an excellent example of this. But I guess, ironically, most companies who develop projects who are eligible for these credits are not cash taxpayers. They don't have a tax appetite. And so they have to partner with other companies who do have tax appetites to monetize these various incentives. And so this is a concept called tax equity investing. And I'll touch upon that here more in a moment. But I guess starting off, let's think about the companies that do have tax appetite. They're developing projects, they have tax appetite, and they can use the credits against their tax liability. And I think it's important to note two provisions related to the IRA. The first is that the IRA extends the carryover periods. So prior to the Inflation Reduction Act, you could carry back credits 1 year and you could carry them forward 20 years. Now you can carry back 3 and carry forward 22. So the reason why this is important is because if you're a developer who isn't perfectly tax efficient in a given year, you might have additional flexibility as it relates to the carryover rules to monetize these credits. The second item relates to the new corporate AMT that came about as a result of IRA. And if a company is subject to the IRA, it's important to note that they can utilize these credits to offset their AMT liability, subject to certain general business credit limitations. So basically, a company can offset 75% of their tax liability, including the new corporate AMT, with tax credits under those general business tax credit rules. That's for companies who are tax efficient. What's more common, though, and the second way to monetize credits, as I kind of alluded to a few moments ago, is for companies without tax appetite to partner with companies that do have tax appetite to more efficiently monetize the credits. And those partners are called tax equity investors. And prior to IRA, the concept of tax equity was executed through a variety of financing structures, most commonly through a structure called a partnership flip. And what's potentially a game changer in IRA are these two concepts of direct pay and transferability. So this first concept of direct pay, in its simplest form, it's just a refundable tax credit. So instead of having to enter into a complex tax equity financing arrangement like a developer historically would have to do, an eligible entity may elect to receive the credit benefit via this direct pay election, this refundable credit option, even if they don't have a tax liability. The thing with direct pay, though, is that it's, with limited exceptions, only available to a small group of entities, such as certain tax-exempt orgs, states and their political subdivisions, Tennessee Valley Authority, and a couple of others. But those exceptions that I just mentioned are important, where all taxpayers, generally speaking, can select the direct pay option. And those exceptions relate to the carbon sequestration credit under Section 45Q, the new clean hydrogen production tax credit under Section 45, and the advanced manufacturing production tax credit under 45X. So that's at a high level the concept of direct pay. The second alternative, which will be more broadly applicable to really all taxpayers, is a transferability option. And as the name suggests, a project who makes the transferability election, and which is an annual election, by the way, can sell the tax credits to an unrelated third party, again, without having to enter into the complex mechanics of a tax equity financing structure.
So how would this concept of transferability affect the tax equity market?
So great question. Yeah, there are a lot of different factors to consider. Just at a high level here, I think the existing credits that we've been working with tax equity financing structures for a long time, things like solar projects that generate investment tax credits, wind farms that generate production tax credits, I think they will tend to continue to use traditional tax equity, as we've found through modeling out various scenarios that it tends to result in the most efficient financing structure. Whereas I think some of the newer credits, which are intended to stimulate development of new technologies, I'll use clean hydrogen as an example, will probably tend to favor transferability in the short term until the new technologies have an operational track record and tax equity investors don't feel that there is a technological risk associated with these types of investments. So just given the broad number of expansion credits and the new credits that have come about as a result of IRA, I would say that the tax equity market, whether it's traditional tax equity financing or whether it is companies buying credits under the transferability option, is going to really explode. There's going to be a tremendous need for more tax equity. And a couple of considerations that might favor transferability over a traditional tax equity. Well, tax equity investors are generally interested in an effective tax rate benefit, which is generated by tax credits. And they're not as interested in the tax deductions, the tax losses that often follow with these projects. So the idea that a tax equity investor could just buy federal tax credits is really attractive to a lot of investors. I also think that there's potentially simpler accounting associated with projects that elect transferability. Renewable energy projects in particular often utilize a method of accounting called hypothetical liquidation at book value, which results in tax equity investors reporting pre-tax losses related to those investments. And that has really limited the tax equity market over the years. So I think taking that out of the equation and just purchasing credits under the transferability option can be really attractive to tax equity investors. And then conversely, some of the considerations that might favor traditional tax equity over transferability is that transferability, as I mentioned, only monetizes the credits. And these projects do generally throw off tax losses in the early years because they're eligible for accelerated depreciation deductions. And so if tax equity isn't in the deal monetizing the depreciation deductions, then the sponsor, the project developer, has to figure out how to fill that gap in their capital stack when tax equity is not monetizing the depreciation shield. And the other is a really, I think, interesting thought here as it relates to these projects do generate tax losses driven by depreciation deductions. And so a traditional tax equity structure might be really appealing to a company that wants to lower its base for computing the new corporate AMT. So those are some of the considerations. Certainly not an all-inclusive list, but I think we are still going to see a very robust tax equity market.
Well, there's certainly a lot to unpack in this act. Carl, which provisions may be of the most impact?
Carrie, I think it's the provisions that offer bonus credit adders. So, for example, when you look at prevailing wage and labor requirements or apprenticeship requirements, you can qualify for a full bonus credit amount. Certain prevailing wage and apprenticeship requirements must be satisfied. And so that's the first requirement that I would look at. The second one would be domestic content. So you can increase the base credit or the bonus credit amounts available for certain projects that satisfy a new domestic content requirement. And then the third one would be related to energy communities, where you can, again, increase the base or the bonus credit amounts available for certain projects that are located in energy communities. So think about like census tracts or geographies with certain coal, oil, or gas activities. One thing that's really exciting about these bonus credit adders is that they can all be stacked together. So once you start stacking these adders, you can end up with some pretty lucrative incentives for companies.
Well, this has been a great initial discussion. You've clearly made the case for why we need additional podcasts so we can explore some of these credits in more detail, and looking forward to our next discussion on advanced manufacturing. In the meantime, if people would like additional information, you can find that document that Carl referenced on Deloitte.com. Just go and search Inflation Reduction Act. And you can also connect with both Carl and with Bill on LinkedIn. And we hope you are able to join us for the next episode. In the meantime, thank you all for joining in. I hope you continue to be well, everyone.